Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing all right, Will. So as you know, I'm a big K-State sports fan. Did my undergrad at Kansas State University, and we got a big in-state victory last night over our in-state rivals. So I'm pretty excited about that. Woke up a little bit disappointed this morning at the news of Toby Keith, but wish his family well as they go through this process.
So a pretty big roller coaster of emotions to start things out, or start the day
That's
out
right.
and then close last night out. But looking at a roller coaster, that's something the markets really haven't been on for the last couple of weeks now. We saw a little bit of strength coming into wheat briefly, and then that kind of dissipated over the course of the week. So I'm going to give you a full rundown of where we sit right now. March 24 corn is up 2 cents at 442. December 24 corn up 3 cents at 477. March soybeans up 2 cents at 11.96. November soybeans down 4 cents at 11.76. Soybean oil on a cents per pound basis was down 0.23 cents at 45.33. Soybean meal by the short ton up 6.80 at 361.10. That March wheat crop down 3 cents at 5.90. July wheat down 6 cents at 6.03. And then the crude oil prices by the barrel down $3.94 at 72.84 for that April contract. So, Ben, we saw some, light gains in some areas, light losses in others, but really still kind of moving sideways along here, week over week.
Sure. Yeah. One of the big things that popped up over the last week that, led to some, I guess, just further deterioration maybe in this deflationary period that we're in for the commodity sector is economic reports and economic numbers continue to come out, surprisingly strong. And again, it just fits into that message of our resilient economy. And I know there's people out there facing inflation and budgets are getting pinched, but a lot of the indicators that we're looking at from a job standpoint, and even just really an unemployment and consumer price index and consumer confidence, just keep coming in stronger than expectations, and that's going to keep the pressure on the Federal Reserve to maintain their position on interest rates, and it's creating a higher U.S. dollar relative to other currencies, and that creates headwinds for U.S. commodities, and so that has been plaguing us for a while, and I think it was just again once reminded last week as we saw key economic numbers come out.
Well, and Ben, noting those jobs reports that you saw, a little bit more vibrant maybe than expected, but there was a little bit of, I guess, I don't know if conflicting numbers would be the right way to put it, but so looking at the jobs creations, those were up of double pre-report expectations, like you've noted it in some of your reports here recently. But you also noted that unemployment benefits exceeded expectations along with those. So what does that mean whenever you see those two things both kind of move upward?
Well, so the doubling of the jobs in January rather than what we anticipated. So almost 353,000 jobs compared to an expected 170,000 jobs. That's very bullish. Continues to show that, or I shouldn't say bullish, but that's very strong, and that means that there's people still looking, creating jobs, still looking for workers. And then to see the unemployment number stay at 3.7% instead of going up to an expected 3.8% just means that we continue to see, that jobs are created and they're continuing to fight for workers. That's triggering more into the hourly pay. We're seeing stronger hourly pay increases rather than people switching jobs and getting higher jobs by switching jobs. But all of that connects to what I just said, a few moments ago about this just continues to keep pressure on the Federal Reserve to maintain interest rates where they're at. And frankly, if we get to the back end of the year, it is an election season, but if we get to the back end of the year and we start to see inflation start to kind of creep back in due to consumer confidence coming back and things like that, when I say consumer confidence coming back, we've seen very strong consumer confidence indexes relative to expected here as of late. That has the potential to spark inflation again, like to start increasing inflation again. And the Federal Reserve might be forced to increase rates. The expectation right now is that they're going to cut rates. yeah, at least by a point to a point and a half by December of this year. And I have a hard time seeing that.
Yeah. So a lot of water to go under the bridge before we decide where that goes. But talking about it being an election year, one of the notable news events that occurred earlier this week, uh, you know, Donald Trump mentioned that if he were reelected, he would be opposing about a 60% tariff on Chinese trade. So looking where that sits, what would that mean looking at maybe a trade war 2.0 with China? As a possibility in the future, what could that mean for the ag sector?
Well, so you raise a really good point or a really good question. It could open a can of worms across a multitude of discussion points. Just as a quick reminder, when President Trump, and a lot of our listeners remember when President Trump was president 4 years ago in 5 years ago, in 2018, he imposed tariffs on the Chinese on goods coming into the country. In some ways, this was protectionist policies to help increase domestic manufacturers and domestic industries like solar panel, aluminum, stuff like that, steel. They retaliated with tariffs on U.S. products entering the Chinese market, which in a lot of ways is heavily dominated by ag products, agriculture products, and we saw a huge deterioration of ag exports into the Chinese market. What has transpired since then? So the Biden administration has kept a lot of those tariffs in place. China has kept some of their tariffs in place as well, not all of them, but it has largely continued. Now the candidate Trump is now talking about increasing those rates all the way up to 60% for China, and then 10% across the board for everybody else. And this has an interesting an interesting outlook from the standpoint that our commodity sector is in a little bit of a different place today than we were in 2018, from the standpoint that we have a lot of production and we got to find uses for it. But we're also in the same situation now as what we were in 2018, in the fact that we're seeing some really soft demand for the product. Similar in 2018, we had African swine fever that was reducing the hog herd in China, that kind of reduced demand for the product and allowed China to kind of, add tariffs to soybean product and other ag commodities without really hurting their domestic consumers, because again, the domestic consumers weren't buying as much. So, the picture in some ways is the same, but also it's a little different
Yeah.
too. So
Well, and now you have that unique issue, or not issue, I guess, but situation where, South American exports have really been what's been dominating the market going to China, especially as probably the marquee buyer within the market. And, Ben, something that you shared the other day on Twitter, and viewers and listeners, if you don't already follow Ben, you should on Twitter at Ben Brown MU. But you shared a really interesting graph that showed that even though part of South America is having a little bit of dryness and maybe pushing down some production value, there's still a massive player in the market, and they're still producing more here recently than they did maybe 3 or 4 years ago, when they saw even more extended periods of dryness. So as we move forward here, I don't want to paint too bleak of a picture, but you're kind of getting squeezed from two different sides there, potentially looking at maybe a buyer trying to exit our market and then having an alternative maybe to go to.
yeah, so South America just continues to ramp up production, even though Brazilian soybean production has, or at least expectations of Brazilian soybean crop has deteriorated. It hasn't sparked markets, and part of the reason for that is twofold. One, it's still expected to be their second largest crop ever. Last year was a record by far. This year still expected to be a record, and we'd have to deteriorate a lot further to even get down to third place, right? So a huge amount of soybeans in the Brazil market to start with. Second thing, I have 3 points. Second point is Argentina production has rebounded very strongly this year from multiple years of drought, looking almost at 51 million metric tons of soybean production out of Brazil, a country that last year was in the upper 20s to lower 30s for most of the year in terms of expected production. So an extra 20 to 25 million metric tons just out of Argentina alone. That is helping, offset some of these cuts we're seeing in Brazil. Although, again, it's the second largest crop expected for Brazil. And then the third thing is a lot of Brazilian producers are just sitting on a lot of unsold grain. And so, given the opportunity to move that product to the market, is creating cash bids that are very low. And it's creating opportunities for global consumers to enter that cash market, buy soybeans, and have them shipped to different places cheaper than what they could buy them from the US or other sources of product.
Well, and seeing the situation unfold, something that we might get a little bit more insight in coming up on Thursday is USDA's February supply and demand report. Looking at all these things. So, Ben, here winding down here real quick, do you have any early expectations for what that report might look like coming out later this week?
Yeah, so the trade estimates that came out earlier this week, and these are kind of a summary of what analysts expect for the report, and they kind of come up with a midpoint. There's two comments that I would like to make. In general, the commodities, corn, soybeans, and wheat, and others, but those three in particular, the expected outcomes are in a relatively wide range, meaning that I think there's quite a bit of uncertainty here in terms of what's going to happen. I don't know if there's broad uncertainty in the eventual outcome or just uncertainty in terms of at what point does USDA make cuts to different demand sectors. I think that might be actually where the uncertainty comes from, because I think when you look at some of these products, like soybeans, for instance, I think eventually USDA will make a revision to the U.S. soybean exports. Our soybean pace here as of late just has not been able to maintain where we need to be. Plus, we're already in a hole, so we need to be exceeding historical levels just to even catch back up. And so I think they will have to make adjustments. Some of that's going to be offset with a higher crush value. On the wheat side, I think they got to make export adjustments as well on the wheat side to the downside. And when I look at these trade estimates, the average midpoint of all these estimates is actually lower, calling for tighter stocks than where we were in January. And again, I think that's partially just due to timing. Maybe USDA doesn't make these revisions until March or April. I certainly think they could do it here in February, and I wouldn't be surprised to see higher ending stocks here in February than what USDA was in January and what the market is currently anticipating for February.
So a lot to look forward to within that report. Ben, including that report, looking at the rest of the week, what should farmers and ranchers be paying attention to?
Yeah, we don't have anything really out, new relative to last week. Last week was kind of a big week with a lot of beginning of the month reports coming out. This week it's pretty much our standard week, except for on Thursday, as we just talked about. We get those USDA updated supply and demand reports Thursday at 11 a.m. Central.
All right, Ben, it's always a pleasure to have your knowledge here on the program. Viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.